Hello and welcome to today's Five with Fitz. I'm Keith Fitz-Gerald. Thank you very much for watching and for joining me. I'm out a little later than I'd like to be normally, so thank you for understanding. Sometimes on days like today when things are all over the place, you just got to check the data again and again and again. Anyway, here's my playbook. What bears still can't grasp, but smart investors should. Now, we've talked about this a lot, and there's no sense in me yelling from the rooftops any longer. Either you get it and you're investing accordingly, or you don't and you won't. S&P 500 earnings may exceed 32% this year, up from just 15% that the Boffins thought was possible last January. What you want to focus on is something that we talk dang near incessantly about. AI is going to alter the course of our planet, and investors who recognize what's happening will have a very different outcome than those who fight the system or long for the past. Anyway, the narrative that I laid out on CNBC years ago that raised so many eyebrows long before anybody else on Wall Street that I was even remotely aware of latched onto what I'm talking about is now mainstream. Every business on the planet is going to adapt, adopt, or die to AI. There's a clip on the CNBC. You can look that up on my channel. Anyway, Palantir, three things Burry gets wrong again. Now, I joined Stuart Varney ahead of today's opening bell for a look at two topics that are making the rounds. What Burry's getting wrong about Palantir again, and why SpaceX's lockup didn't produce the wave of selling that everybody expected. You can watch that video elsewhere on my channel too. I expect some big numbers for both companies by the end of the decade, by the way. Number 3 today, most investors could still double the shares and not have enough. All right, here's the deal. NVIDIA signed deals yesterday with six of Wall Street's largest money managers. I think it's Apollo, Blackstone, BlackRock, Brookfield, Goldman Sachs, and KKR, right? That's 6, right? To build financing platforms that could funnel more than $500 billion into an AI infrastructure. Now, critics are blathering on about so-called circular financing, which, by the way, demonstrates a complete lack of understanding of what circular financing actually is. But I digress. Here's the meat of the matter and what you want to focus on. Many of NVIDIA's customers need more chips and data center capacity than they can pay for in cash, right? Pretty straightforward problem. Thanks to NVIDIA, they will now be able to go to new independent financing platforms being set up by NVIDIA and those 6 big firms that I've just mentioned to borrow the money. Now, NVIDIA's customers then use that borrowed money to buy NVIDIA chips and build the data centers. Now, over time, the customer repays the lender with interest from the revenue generated using running AI workloads on those very chips. It's like leasing a car. Anyway, NVIDIA itself does not lend the bulk of the money, so there's no impact on its operations nor immediate impact to its balance sheet. In fact, in some cases, it might even offer limited residual value support, up to 25% of a deal, to make the financing more attractive to the banks, even though the primary capital and risk assessment comes from Wall Street firms. Now, CEO Jensen Huang, Uncle Jensen, told CNBC this is really the first time that technology chips have become an investable asset class. Now, I agree with his statement. But the challenge is we've been talking about this idea for the better part of several years. Now, of course, I don't know if Jensen's reading it or not, but whatever. Chips have always been an investable class, in my opinion. Wall Street has simply never had that brain cramp because they consider them a product, whereas I consider them a must-have product and service. There's a big difference. Dare I say it, most investors could double the amount of shares they have invested in various companies operating in this space. And yes, probably still not have enough. So let that sink in. There's an image on the 6th wave, which is where we stand, the cusp of one of the greatest trajectories in human history. Look at it in the written version. Now, there is one caveat. Admittedly, it's a big one, right? Before we go on. They're not all text the same, so please pick carefully. Buy the best, ignore the rest. Something you hear me say all the time applies. Keith's investing tip. Many investors spread their money around because they're playing not to lose. The problem, especially a situation like this one, is that leaves them with a little of everything and not enough of the stocks that will actually move the needle. Now, tons of folks think they have this covered, and you might be one of them, but very few actually do. There's a chart in the written version of 5 with Fitz. I want you to look at it. It's from our recent client conference we call Shindig 26. If that idea is appealing, interesting, or even helpful, you might enjoy one bar ahead like other investors do, particularly if you want to be ahead of the herd, not fighting for Wall Street's table scraps. All right, number 4 today, the GLP-1 war just went global. Here's who I'm backing. Eli Lilly's Foundeo just won its first approval outside the United States. In the UK, gave it a green light, making it the only the second oral GLP-1 weight loss pill approved anywhere in Europe. Boy, that's a mouthful. Novo, of course, got there first and racked up roughly like 300,000 UK patients in the first 3 weeks alone with Wegovy, I think it is. But Foundeo's got one real advantage in that there are no food restrictions, right? You see, the Wegovy pill, as I understand it, has to be taken on an empty stomach first thing in the morning, water only, nothing else for 30 minutes. Foundeo apparently skips all that. I'm very excited, right? And I don't take either of these drugs. I'm just speaking from anecdotal evidence and research. The oral GLP-1 category is still very early innings. Injectables still dominate today, but pills remove what is potentially the biggest barrier, needles, and should significantly expand the total addressable market over the next 5 to 10 years. Convenience, in this instance in particular, really is a competitive advantage, and Lilly's got it. All right, number 5 today. Here we go. Florida borrowed a joke from Seattle, and it still works. Now, real estate agents in Seattle put up a billboard back in 1971, and it read, "Will the last person leaving Seattle turn out the lights?" Boeing had just gutted its own workforce. The city was the punchline of the moment. But the line has outlived every headline that it was mocking. It's been recycled for every declining city that's come since, right? I mean, since 1971. Anyway, Florida just borrowed it, or a version of it. Fox Business is reporting that the state's Chamber of Commerce has named New York City Mayor Zohran Mamdani as Economic Developer of the Year on a Times Square billboard, thanking him for the jobs, companies, and residents leaving New York for Florida. Now, as you know, I do money, not politics, so let's keep any keyboard punches above the belt, as the old boxing expression goes. I'm interested in, is there an investing angle here? And I think there is. What strikes me is the pattern sitting underneath the punchline. You see, every time a city or state gets mocked on a billboard for losing its people, there are two industries that show up on the other end of that migration and quietly go to work, period. Companies that rent the trucks and the companies that hold the boxes. Meaning, moving and storage stocks have tended to hold up, sometimes thrive, in 3 specific environments: credit crises, mild recessions, and rate cut cycles layered on top of an ongoing migration that's already underway. So, for example, during the 2008 credit crisis, public storage REITs fell an average of 11%, while the broader REIT index fell 37%. The S&P 500 fell 57%. In the early 1990s recession, storage revenue kept climbing even as the wider economy stalled because sizing households needed somewhere to put their stuff. And every time rates have turned lower, while migration stayed hot, the sector has caught a second wind, so to speak. Now, the setup right now is similar, but a little different. The Fed is heading towards cut, and people are still moving south in large numbers. Checks 2 out of the 3 boxes at once. We don't have a recession. I don't want to be very clear about that, but 2 out of the 3 boxes. So here's where I'm inclined to start looking. Americo, which is, parent of U-Haul, is the largest do-it-yourself moving and storage company in the country, roughly half the market. I've used them plenty over my life. Avis Budget Group owns Budget Truck Rental. It's the second largest truck rental network in the country, alongside its car rental business. Public Storage, right? Now, this is the largest self-storage REIT, if memory serves, with a fortress-like balance sheet and heavy exposure to the Sun Belt migration corridor that runs north to south. Then there's Extra Space Storage and Cube Smart. Those are sort of next-tier storage REITs, both of which ride the same demographic wave. Again, forget about the politics, right? The billboard is a thinly veiled joke. I get it. But the moving trucks aren't. People who leave high state taxes or states to high tax states, boy, this is a mouthful, for low tax ones, need a truck to get there and the place to put what doesn't fit in the new house right away. Now, people on the move don't care who's in the White House, Gracie Mansion, the governor's mansion in Tallahassee, or any other mansion for that matter. So I think it's worth thinking about. Anyway, Keith's investing tip: trucks and boxes, by the way, have outlasted politics and every city that's ever been told to turn out the lights, but kept them on anyway. I love New York. I miss you guys. Let's make it happen. Get there soon. Anyway, bottom line, opportunity tends to show up where and when people least expect it. As always, let's make it a great day with that in mind. You got this. I promise. Thanks for watching. See you later.